Hello everyone, here are the solutions to exercises 4 through 6 from Unit 8. In exercise 4, Thompson Tools believes it is financially unfeasible to do a physical count of its inventory on hand and has chosen instead to approximate the ending value of its inventory using the retail method. So for the retail method, what you're going to have to do is you're going to have to keep track of your purchases and any markups or markdowns you had to price during the period. So when Thompson began this period, the inventory that they had on hand at the beginning of the period cost them $1,500 to acquire. However, they intended to sell it for $1,900, so that is its retail value. They purchased $32,250 worth of inventory during the period, and that inventory intends to sell for $41,700. They marked up inventory during the period, so they raised the price temporarily, trying to maximize their revenues. They had $1,800 in markups. That period ended and they had to cancel some of those markups, so they canceled $400 worth. They had markdowns. Sales intended to push inventory. They marked down their inventory by $1,600. Didn't move all the inventory before the sale ended, so they canceled $1,200 of those markdowns, and they had $38,600 worth of sales during the period in total. And with that information, we can use the retail method to figure out ending inventory at its cost. To do this, you're going to start by taking your beginning inventory and filling in both the cost and retail value for that beginning inventory. So they had $1,500 in cost and $1,900 worth of retail value for their beginning inventory. We're going to do the same with purchases. They purchased $32,250 worth of inventory, and that inventory had a retail value of $41,700. So their merchandise that was available for sale is just the sum of the two numbers above it. $33,750 is the cost. Retail value is $43,600. Now let's factor in our markups. They marked up inventory by $1,800, but they canceled $400 of those markups. So their net markups were $1,400. Well, if we go and we add that $1,400 to the retail value of inventory, we're going to come up with $45,000. The goods available for sale after markup for cost does not change because you don't mark up your own cost. So at this point, we have what we need to figure out what is called our cost to retail ratio, and that can be found via the following formula. We take the historical cost of goods after markup and divide it by the retail value of our goods after markup, and it's going to give us our cost to retail ratio. Well, the historical cost of this inventory was $33,750. The retail value of it after markup is $45,000, and we divide it out, we get 0.75. And what they're saying is that the cost of goods for this company is about 75% of what they intend to sell it for in the future. We factor in our markup, so let's factor in our markdowns. So their markdowns were $1,600. They canceled $1,200 of those markdowns, which means that their net markdowns were only $400. It's a markdown, it's lowering retail price, so let's subtract those net markdowns from our retail value of inventory. Our sales price of goods available should be $44,600. Subtract from that our sales of $38,600 means the company has $6,000 worth of inventory on hand at retail. So at the end of the period, the inventory that the company still has a retail or sellable value of $6,000. But that's not what we reported at, because we report inventory at cost. So how do we convert from our ending inventory's retail value to its cost? Well, that's what the cost to retail ratio is for. If we take our ending inventory at retail value and multiply it by our cost to retail ratio, we're going to get our ending inventory at cost. So we take $6,000, we multiply it by 0.75, and we determine that this company has ending inventory at cost of $4,500. For question 5, let's do the same thing, this time for ABC Company. We have all of their information, their beginning inventory at both cost and retail, their purchases at both cost and retail, and then their markups and markdowns and amount of sales. We're going to fill out the same table. ABC Company's beginning inventory had a historical cost of $14,000 and its retail was $20,000. Purchases cost $46,000. The retail value of those purchases is $59,000, meaning our merchandise available for sale had a historical cost of $60,000 and a retail value of $79,000. Factor in our markups. Markups were $2,400, but they canceled $1,400 of those markups, which means their net markups were $1,000. Markups increase the retail value of inventory, so now we have a retail value of our inventory of $80,000. The cost is still $60,000. We throw those numbers in under our goods available for sale after markup row. $60,000 cost, $80,000 retail, and we now compute our cost to retail ratio. The historical cost of goods after markup was $60,000. The retail value of those goods after markup is $80,000. Our cost to retail ratio is again 0.75. Let's account for our markdowns. They marked down inventory by $1,000, but they canceled $600 worth of markdowns, which means their net markdowns were $400. And when we subtract our net markdowns from our retail value of inventory, it's going to come out to be $79,600. Subtract from that our sales, and our sales were $71,200, giving us ending inventory at retail of $8,400. And to convert our ending inventory from retail price back down to cost, we take our ending inventory at retail and we multiply it by our cost to retail ratio. 75% of $8,400 is $6,300. That is what ABC Company will report as its ending inventory on its balance sheet because it's reported at cost. One more question, and this one has to do with the gross profit method of valuing inventory. This is a fast, easy approximation method which is incredibly popular amongst auditors. To do this, you're going to have information about the company that includes beginning inventory, the amount of purchases during the period, the sales revenue that the company recorded during the period, and that company's typical gross profit percentage. So over time, what percent of sales revenue turn into gross profit. For XYZ Company over here, Aberdeen Auditors is going to look at their books and find out that they had $500,000 worth of inventory. They purchased $550,000 worth of additional inventory during the period, and they recorded sales revenue of $1.2 million. Also going to have determined that this company has a gross profit percentage of about 25%. We have everything we need right now to use this gross profit method to estimate the company's ending inventory. Let's start with this. Sales revenue. Company recorded $1.2 million worth of sales revenue. Let's throw that number into our partial income statement over here. And then we're going to reverse engineer this, if you will. See, we don't have all the information we need yet to fill in all that stuff. So let's knock out what we can fill in. Well, what can we fill in? Well, we know what percentage historically XYZ Company has had of gross profit compared to their revenues. Their gross profit percentage is 25%. Well, if they did $1.2 million in revenues and their gross profit of that was going to be 25%, like it usually is, we can go multiply our sales revenue by our gross profit percentage of 25% to determine that XYZ Company should have a gross profit of about $300,000. And we also know that sales revenue minus cost of goods sold equals gross profit. Well, if we have $1.2 million in sales revenue and $300,000 in gross profit, our cost of goods sold must be $900,000. Let's go to our cost of sales section, or our cost of goods sold section, and we'll fill in some numbers here as well. We know XYZ's beginning inventory for the period was $500,000. We can fill that in. We know that they purchased an additional $550,000 worth of inventory, and because cost of goods available is just beginning inventory plus purchases, that's going to be $1,050,000. Well, if they could have sold $1,050,000 worth of goods during the period, and they actually sold $900,000, the difference between those two numbers is what has to be left in ending inventory. So $1,050,000 minus $900,000 means that their ending inventory has to be $150,000.